All right. Hey, everyone. It's Investment Tuesday, recorded on Monday. And today I'm coming with you with potentially urgent news on an investment speculation that I have gone out on a limb on this channel for some time. I think if you search on this channel, I have made, I'm going to say, 5 different videos on this stock. Fannie Mae, Freddie Mac, and this morning, as I was prepping for Investment Tuesday YouTube, I saw this news on Fannie Mae coming shortly. At Pulte is I think he's the CEO of Fannie Mae and maybe Freddie Mac too. I can't keep up. There's so much going on in the world. And then he's also now taken over the regulator of Fannie Mae and Freddie Mac. So if he says news on Fannie Mae and Freddie Mac is coming, I mean, we can see that, the stocks are ripping on Monday. And I'm recording this on Monday, April 14th. So I don't know what the news is, but I've got to believe that if he's putting this out there, it's something that is going to be worthwhile, that potentially it can be market moving. Certainly the stock market is pushing higher. All right, we are going to get into Fannie Mae and talk about what the prospects are for something happening sooner rather than later. I want to talk about all the chaos in the markets over the last week, what my view is, a little Bitcoin update, and then I'm going to close it off. Last week, I went on for an hour. This week, it's going to be shorter. All right. Let me go back and start from the beginning, which is do my legal disclaimers and disclosures, which is as this video and the content from ATG Digital. And that includes, by the way, the podcasts, et cetera, that are done by Dean and Dan, et cetera. They don't do a formal disclosure. They kind of casually mention that, it's not financial advice. But I want to make this clear that my disclaimer and disclosure also applies to them, applies to anything that they put out. Just understand that anything on this channel, this disclaimer and disclosure applies. What you are seeing is present to you as opinion, information, engagement, and entertainment. Next, but all ATG Digital content may contain errors, oversights, and mistakes. Understand that investment operations have significant risks and can lead to the loss of your principal. Bottom line, you can lose money. Some of you may wonder why I go through this elaborate disclaimer disclosure process. It's because I can tell you anytime a profitable trade happens, it goes mostly without comment. But losing money is painful, right? And some people are surprised. Some people are shocked. Some people are stunned. They're like, Paul, how can you, with all your experience, you claim to have run a big hedge fund. You're a fraud. You're a scam. I lost money. Listen, folks, everyone loses money. Everyone has bad trades. I mean, the market is difficult. The market is risky. And I know the vast majority of people in my role would never go and say all this because, it kills sales. It kills enthusiasm. People want to, well, you know what? Hey, putting it out there. Market has risk, right? And things can go wrong. I can get things wrong. But at the same time, the market can also make you a lot of money, right? We just closed out on, I think it was 6 different option trades, many for over 100% on Friday, right? I mean, there's risk, but there's also opportunity. And, that's both sides of the coin. You don't get one without the other. Next, I, the owners, employees, contractors of ATG Digital, own, trade, transact the securities I mentioned in this video, and all content from ATG Digital that I believe is self-explanatory We do not take money from companies or crypto promoters, sponsors, managements of companies to recommend their stocks or crypto tokens. This is now a pervasive habit for people across the board. People on social media are taking money from the managements of companies to promote their stocks. Definitely, it was already a thing in crypto, and now it's pervasive. It's everywhere. So we do not take money from company managements, even though we get offered money, for better and for worse, for gain or loss. What you're getting from me, from us, is our independent point of view. Next, we publish quite a bit of content. The Substack that goes out every day, Ballman Speculating, which goes out every month, the YouTube video I'm on pretty much every week, and sometimes more than once a week. And if there's really big news on Fannie Mae, maybe I'll show up tomorrow. Social media, I'm most active on X, Instagram. Yeah, when sort of like time and inspiration hit me. In Facebook, we are somewhat active. Finally, we have a subscription business which provides investment ideas. It starts at $9.99 for the silver tier, and then we've got gold, diamond, platinum, and they're all pretty economical compared to what the vast majority of people in my role charge. And the essence is that we give you ideas, and then we give you some number of updates that follow it on those ideas and on the market. And if you are looking for something like that, go to atgdigital.media. I suggest starting out with the silver tier. Go watch some updates, get a sense and feel for what I do, what we do. And then I think it'll become pretty clear, what value we can potentially add to your financial life. Okay, back to Fannie Mae and Freddie Mac. What can go on? Let me just put that tweet back up again, because truthfully, when I was doing this, I was not expecting to see this. I was just sort of like going on X and then using search engines and using Grok AI to kind of be like, hey, well, where is this? Is there any actual news? And what instead we have seen is that there's been general reassurances from the Trump administration that these companies are on the path to ending their conservatorships, and that has triggered some amount of news coverage. You can go and just type in Fannie Mae into Google. There's a lot of, there have been changes that have been going on. The board has changed. And then, we now see mainstream media publications like the New York Times getting into this. What it will mean for home buyers. Here's a new one from the University of Maryland, where I'm assuming it's a professor, says it's time to merge these two. There's been some layoffs, some for efficiency, some because of some alleged fraud. Here's another one saying interest rates could go up. Either way, I'm not going to go through all of these. Either way, there is just, people are clearly starting to anticipate, look forward to these companies being set free. And the basic issues in the end are the same, which is that what will the government do with its warrant? Essentially, at least in the way I understand it, they essentially control about 80% of the companies. What will they do with that? How much money will the regulator or the government require these companies to hold, which will determine how much money they're going to have to raise from the market? So those are the sort of like the two big things that would need to be worked out for this. And then I suppose there's also the idea, well, how much regulation will they be subject to? And if the government is going to have, want these companies to play the role that they play today in housing, which helps reduce mortgage rates. And the reason they help reduce mortgage rates, because in the end, when Fannie Mae and Freddie Mac issue bonds, in case you don't know what they do, essentially they take your mortgage and your neighbor's mortgage and everybody's mortgage, and they sort of like pack it up and they sell bonds. And the reason why people buy those bonds is because effectively the US government guarantees them. Without the US government's guarantee, what will be the market for Fannie Mae and Freddie Mac bonds? We don't really know. We have not had a period of time when this has been true for us to gauge. Like, what is how much is people's belief behind America and American homeowners to pay their mortgage? Will a market just take it on faith that American homeowners will continue to pay mortgages at historical rates, or will they need a guarantee? Well, the more they need a guarantee, well, then the government will be like, well, I think you should pay us more. So there's a lot of things going on. I have seen all kinds of price targets put for these companies. Let's put a chart up so we can see what we're talking about here. I'm just going to use Fannie Mae because it is larger, it is more liquid, and it's the one that is easier to refer to. Most people call it Fannie, but it's around $6. And my calculations have it at, being set free, assuming the government takes 80%, assuming that they're going to have to dilute the stock to raise cash. I'll say on the low side, $20 is what I come to, $15, $20. On the high side, $30, $40. But I have seen numbers, wild, crazy numbers. There's a lot of people hallucinating with this of $300. I've seen estimates of $1,000. I don't think those are real. I just want to make that clear. I think my numbers are probably maybe middle of the road to, relative to all of those. But they're based on, again, having followed these companies in conservatorship for all of their life in conservatorship, having owned the preferreds for a long time. I think in the end, they're going to end up being released most likely this year. My best guess is that there will be some arrangement made so that the government does not destroy the potential upside, which is that you have to think a little bit through game theory, which is that if the government just kind of takes 80%, makes them raise a bunch of money, kind of reduces the value of their stake. So it's in their interest to take a little bit less now, with the idea of maybe, if you leave a little bit out there, then you can make more. So I think there'll be some arrangements, some gaming of hey, how do you extract the maximum value here? It's not necessarily by grabbing as much as you can all up front. And in that scenario, then, the upside would be higher. But bottom line to this urgent update, which is that we've got I think he's the chairman, of Fannie Mae and Freddie Mac, as well as the regulators, saying that news on Fannie Mae is coming shortly. The market is levitating higher, anticipating something. What could it be? I can't imagine that they're going to do a press release and talk about hey, we cut some number of people. Hey, we found some number of people doing some fraud, or some minor thing. I have to imagine that it's going to be something to do with the conservatorships. So stay tuned. Follow me on X, and I will update anyone as I find out and give you my interpretation. If the news is dramatic enough, I will come on live and I'll discuss for a little bit. All right. Okay. Let's go back. I'm going to start with this. All right. There is, I'll say, among retail investors, I'll call you individual investors, mom and pop investors, non-institutional investors. There is this idea that, hey, look, we've had this enormous crash, and the stocks that we have been chasing for 3 months, 6 months, maybe 1 year, they're dirt cheap, and we should buy. And if you have been watching my YouTube channel for a while, or you're a subscriber of ATG Digital, you follow me on social media, you know I am not in this camp. I have said for the better part of, I'll say, 12, 18 months that US big indices, what people call the market, so the S&P 500, the NASDAQ 100, they're dominated by a very few stocks, significant number, the Mag 7, obviously. I mean, so tech, and it's also like one industry, tech. These stocks have been in long bull markets, so they're over-owned. They have been bid up like crazy because in the last 3 to 4 years, we've seen new investors come in and pile in, and new investors tend to be focused on the past. In other words, they're like, well, these have all gone up a lot now. They've dropped 20%. That's a buy the dip, etc. However, big money investors are not looking at the world in that way, right? I mean, they have a viewpoint that is driven by evidence, facts, and research. And I just want to show you, like, here's a very large bank. Now they're doing, an asset allocation recommendation. They're like, yeah, I mean, hey, U.S. equities not as attractive, and they're calling it tariff concerns, and they've got all this out there. But there is a deep misunderstanding among individual investors about how to look forward, right? And institutional investors don't use charts and look backwards and say, well, the stock was here, it's now here, and it can go back here. Now, the price may do that, but they base their actions on something other than purely price or charts, right? And in this case here, you got a large bank, their research division saying, hey, U.S. equities, tariff concerns, and they're like, other stock markets and the stocks in other stock markets are more attractive. And they bring up Japan. And, at ATG Digital, we're just about to add one more Japanese stock. I've been looking up more international stocks, and we're going to add more likely like an electric utility from South America to participate in the global electricity bull market. But why are they downgrading U.S. equities and raising the tariffs? Because what the tariffs really do is that they reduce profit margins. If you just think through why the tariff issue exists, it's because starting in the 1990s and then really accelerating through the 2000s, US companies began to ship our production facilities to other countries to arbitrage, lower labor costs, lower taxes, and lower regulatory burdens. So, no pensions, no environmental regulations, or far lesser. And why are they doing that? Well, because they would make more money. It's not that, the amount that you would sell would change a great deal. It's because your profit margins go up. If you're paying lower wages, your profit margins are higher. If you're paying lower taxes, your profit margins are higher. If you don't have to worry about environmental restrictions, you can do all these things. I mean, of course, it's a lot cheaper to operate that way. So the biggest impact from tariffs on US companies is that their profit margins are going to be less than what they were pre-tariffs. lesser. And let's just look at the largest company in the world and the largest company in the S&P 500, in the NASDAQ 100, in pretty much every index, every portfolio, and most likely when you sit and examine your portfolio in some detail through your 401k, through your pension funds, through your brokerage accounts, in all likelihood, if you own SPY, if you own QQQ, if you own pretty much any ETF, the largest holding is going to be Apple, right? So let's look through tariffs through the lens of Apple, right? And what we can do here is, so these are Apple's revenue estimates for the current quarter, right? So the current quarter would have ended March 31st. And these are all the aggregated estimates from all the analysts that cover Apple, right? So in October of 2024, which was about 6 months ago, the estimate was, let's say, 128 billion. Now, Apple's business has been slowing for some time. So I'll say, all these reductions through October, these are just the company and analysts going back and forth and be like, no, your estimate is too high. No, your estimate is too low. Because remember, while everyone thinks that the estimates that sit out there are some perfectly objective thing, I know from having managed money and dealt with managements, it's a tug of war. Sometimes brokers can have a vested interest in having a very high estimate so they can sell, maybe they have the stock in inventory, they'll sell it out, or they can have a vested interest in having a very low estimate because maybe they have a competitor stock or they have some investment banking deal that's going on and they are trying to accumulate cheap stock of a similar company or that company. In other words, massive conflicts of interest, right? But these, moves from 128 to 127, those are the tug of war, right? I mean, nobody's going to buy Apple. I mean, Apple is not going to be acquired by anybody. So, we can take these numbers are essentially just the tug of war where Apple calls analysts and be like, your numbers are too high. You need to get it here. And Apple is trying to engineer the estimate to something that it can either beat by a little bit or not disappoint too much. But what you can see over from October and then through the year is that these estimates have really dropped, right? I mean, so even as Apple stock was levitating higher into December and January, etc., analysts are actually getting less and less and less bullish, right? I mean, and they were lowering their estimates from 128 at the by year end it was 124. It's it's meaningful. It's 4 billion. But then when the year began, which is often a time when estimates are revised and people look forward, it was moved down to 96, which is pretty significant. But it's continued to go down. Normally, that new estimate is set, but it's now a good nearly 30% below where it was in October. Now, this is for one quarter, and truthfully, oftentimes, please, people are like, Paul, I should short this. Well, no, that's a really dumb idea. Because remember, there's an interaction, which is that this information is not secret, right? If I have it, if you have it, other people have it, right? The market is not so dumb and is not so inefficient, right? But just let's look out for the next year, right? And you can see similar pattern, right? I mean, their estimates are starting to go down, and you can see once the trade war started, they're starting to push these down. Let's go for next year, which would be, Apple's fiscal year is slightly different, so it's not quite exactly end in December. But to make a general point, you can see that the numbers are going down. Why are they going down? Well, because the analysts, if they are acting in good faith, know that even if Apple can move some amount of production from, let's say, China to Vietnam, or from China to India, or from China to Indonesia, or China to, I don't know, any other country, they're still going to make less money on their products. I mean, because each place, at the very least, there is a cost to move all that production over. It's not cost free. And they are completely optimized for China, so they can really be efficient over there. So it's going to be less. It's just a function of the degree. Now, Apple has not discussed bringing back production to the United States, but if it did bring back iPhone production to the United States, or even iPad production or computer production, that would be a huge hit to their margins. They would make money, but they would make far less money than by producing in China. And the bigger point behind this, that the same analysis that I'm doing for Apple, you can do for so many of the companies in the S&P 500, particularly the largest companies. And that's true in the NASDAQ 100, and that's true for pretty much every index. Every major basket has these companies. Why? Because it is the biggest companies that could really maximize the advantage of globalization. They're the ones that could ship the most number of production facilities offshore. They're the ones that could have and optimize, tax accounting and find the perfect tax shelter. Maybe it's Ireland, maybe it's Cayman Islands, all these things. And also look at what are the costs of environmental regulation here versus there. Smaller companies, there's no way. It's just too big of a project. It would cost so much money. So the big companies that dominate the indices are going to see their estimates going down. Big investors are forward looking. They also have access to research, facts, evidence. They have teams of analysts that can tell them what I'm telling you. And their reaction is going to be into rallies that come up, they will still be there selling. In other words, it will be a tough time for indices like the S&P 500, like the NASDAQ 100, and pretty much all of those out there. And this is why I have laid out my secret bull market thesis. In other words, the bull market's going to be somewhere else. It's not going to be here. If there are persistent sellers because of lower earnings forecasts for the companies that dominate the S&P 500, and I have in previous videos I've shown you that I think it's the top 10 companies in the S&P 500 are 38% of the index. So these are really concentrated indices. I think the NASDAQ 100, it's 48% is the top 10 companies. So these are very concentrated indices trading at very high prices into a period when their earnings are set to decline, where their growth in earnings is set to decline. And despite people's impression that there has been this enormous crash, that there has been this enormous, crisis of some kind, the truth is the S&P 500, is not, is down about 20%. It's not 2008 when, stocks were down. The S&P 500 was down 50%, but the average stock was down 80, 85%. We're not in that world. And these forecasts are just beginning to come down after a however long run. For shorter term investors, it's a 5-year run. For longer term investors, a 10-year, 15-year run. Bottom line, I'm not bullish on the S&P 500. I'm not bullish on the NASDAQ 100. I'm not bullish on these big indices that are dominated by these big stocks. Instead, I will tell you that the bull market is going to be somewhere else. It's going to be in smaller cap companies. It's going to be in companies that have growth and have some catalyst or factor of growth that is not necessarily related to anything to do with globalization, right? So what's the natural one? Innovation, right? If you have something new that nobody else has, right? Yeah, and then you can sell that and there's a demand for it, there's going to be growth there. So small cap, innovation, and then I mentioned the Citibank note about Japan, international. Why? Well, I mean, because people find those markets to be significantly cheaper. So much of the world's money has come into US markets over the last 5, 10, 15 years. So pretty much everyone is underweight international markets. I come back to this. The bull market is going to be somewhere else. It's going to be somewhere else. It's not going to be in big stocks. So if it's not in big stocks, then it's going to be in small and medium-sized stocks. It's not going to be in companies where the primary engine of profit growth was globalization. Why? Well, because we've got tariffs, and under tariffs, their profit margins are down. Uh, However, if your company was dependent on innovation rather than globalization, you've still got like the growth engine is still there. And then international. That's where people are not. In other words, the bull market is always going to be where as I think it was Wayne Gretzky that says you skate to where the puck's going. And my understanding from reading comments that I get, whether it be in YouTube, and I know I'll get trolled for this because people take the view that like investing is like supporting a sports team, right? In other words, if somebody says a piece of information that you don't like, you should go troll them, try and destroy them. Listen, folks, chill out, right? This is my point of view. If you don't like it, let it go through this year, let it go out this year, change the channel, find somebody that that confirms your thinking, and go that way. For me, as someone that's been in markets for 30 years, I know that shading your news sources to find what confirms you is a terrible idea. You want to take in the information for what it is, and maybe you don't like it, but you go and you research it, and if it's true, then like, hey, markets, yeah, I mean there are periods of wild swings, and it can be very emotional, etc. Yeah, I mean they are driven by growth. They are driven by profits. They're driven by profit margins, and they're driven by where the future is going. All right. A quick macro note, which is another issue that many individual investors, retail investors will get wrong, in my opinion, which is that the Federal Reserve is in all likelihood going to cut and or add liquidity to both markets and stocks. We have seen, I think it was last week, where the Fed watching the markets sort of like, swing wildly, and also watching bond markets go illiquid. They're like, hey, if necessary, we will step in. And in the past, I mean, that's always been a trigger point for them to be either adding money to markets by, might be through lowering interest rates, and it might be through stopping quantitative tightening, which is, them reducing the size of their balance sheet. That's what this original tab that I have information on. In other words, the Federal Reserve has been buying assets to keep asset prices high for the better part of 16 years. I mean, arguably, they've been doing it really since 2000, right? And so during periods of growth and general market stability, what they're trying to do is sell off assets. And remember, when you sell, what are you doing? Well, you're taking cash from the system and pushing an asset out there. In other words, when people are excited and they want to buy, the Fed's like, yeah, here, take. All right. And then, when people panic and nobody wants to buy, if there's not enough cash in the system, then the Federal Reserve, yeah, I mean, they come in and they are the buyer of last resort, if you will, for treasuries and some number of bond assets for about 2 or 3 years. I know this chart is not very big. Let me increase it a little bit. But you can kind of see here, I think the middle chart, make it one more bigger, will just show you what the Federal Reserve has done since 2020. So if you go here, right, this is COVID, and the Federal Reserve just there's a panic in the markets. There's a panic in the economy. There's a shutdown unfolding. Pretty much every kind of production is shut. The world economy, other than, operating for emergencies, is nowhere. And what does the Fed do? It pumps huge amount of money into the market by buying assets, right? Just think about what the dynamic is, right? As COVID hits, everybody wants to sell and wants cash, right? But nobody wants to buy. So the Federal Reserve is like, here, you want cash, here's cash, we will buy, right? And then as the panic petered out, as that built confidence, and obviously we had a big market boom, as it built confidence, it started to raise interest rates, and it also started to sell off some of these assets. Now, when it goes to sell off some of these assets, what are you doing? Well, I mean, now you're like, oh, hey, you want to buy assets at higher prices? Here, we'll take cash. And the Federal Reserve have been trying to reduce it as much as they can. And you know what? They've made some progress, but they're just back to where they were sort of at the middle of the COVID crisis. So why bring this up? Well, because the tariff issue definitely creates chaos, creates stress, creates distress, creates illiquidity. And if there's not enough cash in the markets, then you have these sudden moves like what we saw in the stock market, where everyone wants to sell, nobody wants to buy, especially at those moments. It's like everybody's like, I'm frozen out. Yeah, I'm out, I'm gone. Stop losses are being hit. And at that point in time, liquidity disappears. And liquidity disappears not just in the stock market, it also disappears in bond markets, including treasury markets. Many people have this idea that like, oh, well, when the stock market crashes, everybody's rushing to treasury bonds. However, even within treasury bonds, there's risk and less risk, right? I mean, very long-term bonds are considered more risky. Shorter-term bonds are considered less risky. So even within the treasury market, there's risk being played out as people try to sell long-term bonds and get into cash. Bottom line, to bring all this up, is that they're probably going to stop quantitative tightening. In other words, reducing the size of the balance sheet. And potentially, especially if there are more panics, if there is more seizing up of markets and also seizing up of lending in the economy, they're going to have to push more money in. I mean, I almost certainly push more money in. As it stands already, various people that I follow suggest that they're just like don't have enough money to really run the overall debt system. In other words, we've gotten trillions and trillions of dollars worth of debt, and that demands a lot of like money in circulation, right? And the Fed wants to bring some of that money back in, but it often can't, because if you have a lot of debt, right, I mean, you got to pay interest on that. That takes cash. And the vast majority of companies don't have the money to pay off debt. They have to refinance, right? And oftentimes when they refinance, they want some cushion. So you need even more money, right? So you got to produce all that money. And the analysts that I'm following say, like, we've been running very tight. In other words, there's not quite enough money in the system. So they're on the verge of selling. Here is an example of how much debt that is coming due, right? In other words, we've got, like, in the next 12 months, we got $2.14 trillion worth of, this is corporate debt coming due. And we got another, or over 24 months, about 5 trillion, over 36. And you might be thinking, well, Paul, that's, 3 years away. Yeah, but companies don't want to wait, if they've, once you're getting into 12 months of a maturity, you're running out of time. You're running out of time, right? Because anything can happen during that time period. So as the maturities start to get closer and closer, the companies, especially, if there is something like tariffs, which most companies, they never gave a thought to when they, went out and borrowed so much money. They're like, I would like to get 10-year debt. So like, I've got some certainty for some period of time. Bottom line, the Federal Reserve needs to, in all likelihood, cut interest rates and reduce and increase the size of its balance sheet. In other words, push cash into the system. And that, I think, is going to be very good for certain number of assets. Circling back to why I brought all this up, individual and retail investors are going to look backward and be like, Paul, did you say low interest rates? Let me go in. Let me buy all the tech stocks, because that's what happened in 2020, because that's what happened in 2022. And they're not going to think like, no, those companies, actually, their profits are going down. Their profit margins are going down. There aren't going to be, big buyers to keep stock prices high. So in other words, I'm when the Fed cuts interest rates, increases liquidity to address the entire tariff issue, money's going to go somewhere else other than NASDAQ tech stocks. All right. That's not a guarantee. That's my opinion. It's going. And in my judgment, the number one place where it's going to go, we have a leading indicator, right? It's going to go to something that is scarce, something that is not owned by a lot of people, but where everybody can kind of like see the demand and supply equation is very much in favor. Bitcoin is a clear beneficiary, and in general, crypto in general, because we haven't really had a really true bull market in crypto now for it's about 4 years, right? The vast majority of investors globally don't own crypto. It's a small asset class. The entire asset class is worth about 3 trillion. All assets in the world are worth whatever, 600 trillion. So it's fairly small. Prices could move a lot, right? I mean, if the Fed starts to cut interest rates, push liquidity into the economy, into the market, and people will be like, hey, I want, they're increasing the amount of cash in the system when inflation around the world is still not back to where it was pre-COVID. And we know that people are concerned about this because gold prices keep going higher. We know that tariffs are going to upend the monetary system, the currency system, lots of chaos and instability. And people, I think, are going to come to crypto as being like, well, crypto is independent of fiat currencies, central banks. They're audited every day on the blockchain. You know exactly how many tokens are issued. They run on a completely different financial logic than fiat money. I mean, no one is going to increase the amount of Bitcoin because the markets lock up. Nobody is going to increase the amount of Bitcoin because the economy needs more money, because there's too much debt in the world. Bitcoin doesn't care. It's just, the demand and supply for Bitcoin is going to, the supply of Bitcoin is going to be what it is, right? So if you increase the amount of money that is in the system, and people who have extra be like, well, how do I preserve the value of this? Previously, like, hey, these Mag 7 companies, they churn out cash. They got so much money in reserves, but there's huge uncertainty now with these companies, right? I mean, I showed you what the forecast, sort of trend is for Apple. It's uncertain. Like, where is Apple going to produce in the future? What will their profit margins be? What will their profits be? Apple will feel like they can't buy back as much stock, which is really what has kept, the price high. And sophisticated investors, they're going to get this. So they're going to be like, well, I can't really buy that. Okay. If I stay in dollars, then I got to, potentially deal with all the currency chaos, people talking about devaluation of the dollar against other fiat currencies. So gold is a place people will go to. So, you have no choice to pay your bills. You need dollars, you need cash. You'll stay in cash. Maybe you'll go to euros a little bit. Maybe you go to yen a little bit. But from there, if you got large amounts of money, you're stuck. You can't really go anywhere. However, I mean, it's very clear that the United States government is planning to do something with Bitcoin. So I believe that into any kind of interest rate adjustment, any kind of liquidity shift, Bitcoin is going to be a rocket ship. And I have taken a lot of mocking and a lot of heat. I had somebody call me the dumbest human on earth for saying this, but I think the odds for Bitcoin hitting $1 million somewhere in the next 12 months, yeah, I think the probabilities have just gone higher because I don't think we can get through what we're getting through without the Federal Reserve pushing more money into the system. I don't know how they'll do it. Low interest rates, increasing the size of the balance sheet, going to buy more assets. I don't really know, but definitely when that happens, the demand and supply dynamics for Bitcoin, and I'll add Ethereum because Ethereum's price is now back to where it was at the low in 2021. Remember, Ethereum they're not going to release more Ethereum into the system because of whatever is going on. So you're going to have, essentially fiat of all kinds, because once the US cuts and starts to add to the balance sheet, pretty much remember all the central banks are all running balance sheets like this, right? I mean, they've all been buying their own assets to keep asset prices higher and to keep liquidity flowing in the markets to keep people's confidence up, right? Europe is in the same boat. Japan is in the same boat. Everyone's in the same boat. Once the Federal Reserve starts doing this, they will all do the same thing. So now you have this gusher of liquidity starting to come through that can't go to at least one of the places it used to go to, which is the stock market in the United States, these tech stocks. Yeah, that's not on the list anymore. Gold is on the list. Some number of maybe quite safe, it's very clear to me anyway that electricity is in a bull market, so people will go in that direction. And then there's crypto. In other words, you want something that is going to maintain its scarcity in the face of this gusher of liquidity, right? And Bitcoin, we know, finite 21 million coins that can ever be issued, very elaborate, clear, deliberate, supply schedule, which halves every 4 years. Yeah, you go there. Ethereum, I mean, their supply has not gone anywhere in something like 4 years. There's other crypto that you can talk about. I mean, and many of these crypto protocols, platforms, I mean, their prices are far lower than they were 3 or 4 years ago, but the amount of fees being collected is significantly higher, right? So bottom line, to put all of this together, right? I mean, the Fannie Mae part is separate. That's a standalone issue about one stock. But I mean, I do think even that you can connect. The U.S. government needs money, right? I mean, and that is going to drive the speed of that. So I mean, it's not completely unrelated. But bottom line, overall basis, yeah, I mean, the tariff panic, chaos, instability, whatever you're going to call it, has changed the calculus for what U.S. stocks mean to investors in the United States and globally. It is going to be no longer a place that's an automatic place where people come to buy into an increase in the amount of money in the system, which I expect to happen. The Federal Reserve, for any number of reasons, again, the instability, chaos of tariffs, the fact that, we've got an enormous amount of debt, right, that's sitting there that requires more money for it to be, for the interest to be paid, for it to be refinanced. You got more money coming. And the most likely place it's going to, or the first place it's going to, is going to have the maximum impact. My judgment, my opinion, it's going to be crypto. Bitcoin will get a bunch. Ethereum will get a bunch. Probably some of the DeFi coins that have, lots of total value locked. Those will get benefit in a big way. And then, in other words, there's going to be a new set of winners that are being set up for this new bull market where, there's more money in the system. That money obviously wants to grow. It doesn't want to lose, and will have worked out that the old tech stocks and the S&P 500, the Nasdaq 100, these are not places you want to go to. Some money obviously will have no choice but to go into treasury bonds. Some will go into alternative currencies. Some will have to stay in dollars because everybody's got most of the world's commodities, et cetera, all denominated in dollars. But from there, you go and look, well, what assets have the greatest demand supply dynamic to facilitate higher prices? Seems really, really, really obvious to me that is crypto. And if that's the case, some of my outlandish, dumb, stupid, idiotic predictions, okay, I'm okay with being called all that. For $1 million for Bitcoin the next 12 months, $20,000 for Ethereum. Yeah, everybody's like, it didn't seem thinkable. Or remember, it's so much of what has happened over the last 5 years, 10 years, 20 years has all been unthinkable. I mean, the idea that the Federal Reserve would buy and monetize debt was unthinkable in the 1990s. Yeah, I mean, that it would, go in and buy junk bonds, unthinkable. That it would intervene in markets and manipulate markets in the way that it has, not thinkable. That we would have a pandemic, not thinkable. So while we always like to think in nice, like small linear movements, the truth is that the big changes, yeah, they come in just sudden like whooshes around unanticipated, unexpected events. But it's not like so out of unexpected at this point. I mean, we've got a reordering of the global trading system essentially happening in real time right in front of us. If you go back and study any reordering of the global trading system, go back to the Nixon shock, taking the dollar off the gold standards, the Bretton Woods. It's always been like, it's not like people knew that there was trouble there, and it's sort of like burbled along, and then it was like, poof. So in that scenario, what do you want to own? What do you want to own? I think I want to own Bitcoin. I think I want to own Ethereum. I think I want to own electricity. I think I want to own drones, gold, true innovation. In other words, companies that don't have like a science project. In other words, they've got an actual innovation for which there is demand. So a company like Tesla with EVs and with autonomous driving, companies with innovation that is going to have value. In other words, there's a demand for this. And the demand is based on the idea that, they provide a benefit. Innovation provides a benefit, which is that it's cheaper, it increases access, and it's more convenient. All right. That is my Investment Tuesday. What's the right word? I don't know. Update, forecast, thingamajig. There's a lot going on. There's not a lot of ways to easily define it. And I expect more to be going on. I do not think that what we have seen so far in April, until April, is the end. I think there are going to be more ups, more downs, more ups. I think it is not going to be a crash like this. I think people are going to be disappointed. I think it is going to be up and down, up and down. And then there's also going to be change interspersed in between that. Okay. Thank you for watching this video. Subscribe, give us a thumbs up. And I will be back next week with another one. This is Paul saying thank you and goodbye.